Okay, the lesson of today deals with date and time exact calculation. We have seen in the last lesson how you can move some days in the future or in the past. However, when you have to move months or years, this cannot be done, or better, it can be done only approximately and not exact. There are specific functions within Excel which will let you move forward or backwards in time or build dates which are exact. Let's see them. We open the usual file. We go to date 2. Okay. This is something we have already, very similar to ones the thing we have already done before. Let's see first of all how to extract parts of a date. So suppose you have a date given in a cell or given by the function today, and you want to extract a part of it. For example, you want to extract the year. In this case, you type equal year, and here you press the reference to a cell which contains a date, or you simply write today if you need the year of today. Okay, this will give you the year of today. It seems something strange, which completely useless, but it's the only way to get the year of today in a dynamic way, and it's the only way to extract automatically the year from a date which is already written in your Excel sheet. So, same thing for month. Pay attention to the number of parentheses. Same thing for day. Okay, why do we see these things which are not completely useful by themselves? Well, because now we'll see how to go forward of exactly 1 month. I repeat, doing something like this, it's allowed, but it's approximate. Not every month has exactly 30 days. Okay? In order to go forward of exactly 1 month, you need to use the function date. So there is a function called date, D-A-T-E. Okay? The function date is a function used to build a date given the year, the month, and the day. For example, if you write date 2009, semicolon, 12, semicolon, 10, it will be the 10th of December 2009. Well, this function may seem really silly to you, because you can do the same simply typing 10/12/2009 and it's done. Okay? But the function is completely useful in combination with year, month, and day. So if you use it in combination with year, month, and day, you can really play with dates a lot. For example, suppose I ask you exactly to take today and go forward of exactly 1 month. What will you do? You will do date of year of today. This function here, this part here, will return 2011, semicolon. Now, month of today. This part here will return today's month, which is February, so 2. Okay? But since I want to go forward exactly 1 month, I just type +1, semicolon, day of today. Okay? This one will return the day of today, which is the 8th. Pay attention to how many parentheses do you open and do you close. Now you will appreciate the fact that Excel colors your parentheses, because otherwise you will be in trouble. So you will not understand which parenthesis closes with which. So you press enter, you can see exactly today, the 8th of March 2011. So it's a precise way to go forward of 1 month. So if you use the date in this way, so you build dates with a combination of date function and year, month, and day, you can really play with it. In fact, you can see you can go forward 1 month. If you want to go backwards 1 month, you just type -1. What happens if you type -20? If you type -20, today is February, so the month is 2. If you type -20, the result here is -18. Excel should return an error, because month -18 should not be accepted. So the function date should not accept a month which is -18. A negative month doesn't make sense. But it does not. It does not return an error. Instead, Excel is so smart that it understands that with -18 you mean that you must go 18 months backwards, starting from December. So minus 18 will be probably June. Let's check. 8th of June 2009. So we have gone backwards 18 months, so 1 year and a half. Okay. Same thing if you go forward. If you write plus 20, Excel will not give you an error because you have here 22, but we'll understand that you want that month 22 should be considered month 12, December, then go on other 10 months, okay, October 2012. Okay, so Excel can handle correctly month and days which go beyond the official limits. So it's very robust function and very useful. Let's see this one. Today minus exactly 1 year, 3 months and 7 days. So equal date, year of today, minus 1, semicolon, month of today, minus 3, semicolon, day of today, minus 7. Okay. Again, the month of today minus 3 will yield minus 1, but Excel will understand that month minus 1, you mean December of the previous year. So it will be probably December 2009. Let's see. Oops, there's an error. Point parenthesis. Okay. Name. Let's see. Where is the error? Today without parenthesis here. Today without parenthesis here. Okay. November 2009. Okay. So this is the way you can play with dates. For example, I ask you, write here a date, the 1st of March 2015. Okay. And here I ask you, build a date. I will write it so you will get it. Build a date with year 2009 and month taken from cell C6 and day of today. Okay. So build a date with year 2009, month taken from cell B6 and day of today. So you can see you can really build complex things. Date of year 2009, month taken from that cell, so month taken from that cell, and the day of today, day today, another parenthesis. Okay, year 2009, month taken from this cell, and day of today. Okay, so you can really do complex things without any problem. Okay, the only thing I warn you is something I've already warned you. You may never do something like this. Equal month 3 February 2011. Because Excel believes that this is not a date for Excel. For Excel, it's a mathematical operation. Okay. Same thing, you cannot write something like this. Excel will get totally confused, as you can see. Okay. If you really need to do something like this, you should write 3/2/2011 in another cell and make a reference to it. Okay, so pay attention, dates are never accepted directly inputted. Okay. Okay, again, build the date with year from cell B10, month, June, and day of today. Very easy. Date of year from cell B10. No. Pay attention. Yes, this is correct, sorry. Month, June, so June is 6, and day of today, day of today. Here you have. Now again, your birthday, 20 June 1986. Okay, my birthday. When you were 13 and 6 months. So how can we calculate? I want to see the date, not when you were 13, which is rather obvious to calculate. It's 26 1999. But when you were 13 and 6 months. So you should take your birthday and go forward of 13 years and 6 months. So date, year of birthday, plus 13. Month of the birthday, plus 6. Day of the birthday. So this is your, let's say, birth, half birthday, 20 December 1999. Okay, This is everything which I have to tell you about date. Pay special attention to this date function. Okay? I ask it very often in the exam, and many people, when I ask go on 3 months, make it wrong, so add plus 90 or are not able to use the date function properly. Okay, now we switch to financial functions. Okay? In order to understand financial function, you must, now you should stop listening to the video and you must study the book. So there's a specific book on financial functions, is this one. This is the website of the course. The financial function course book. It's a book which you may have at the practical part of the exam, so you don't need really to study it, but you should need to read it to have an overview of financial function, especially of finance, because I've seen that many people don't understand finance and don't have enough knowledge of finance to understand which exercise do we do. Okay, the book is a complete overview. The book includes also the lessons that I will do now, but I suggest you to read it before listening to the rest of the video. Okay, now, given for granted that you have read the book, okay, let's talk about net present value. So, net present value. Okay, here you have a cash flow. On the 1st of March 2010, you pay 1,700. 20 September 2011, receive 3,500. 10 December 2012, pay, and then receive. It's a very strange cash flow. Maybe you have made a loan with a friend, or better, the friend has made a loan with you. You have given him this amount of money, then he gave you more. So it's a quite strange thing. Let's calculate a net present value. Okay. You simply, first of all, the rate. Okay. So you should decide your discount rate. It's a personal decision, or it's written in the text. So 3%. In 2011, 3% is a good discount rate. The values and the dates. 76.31. It means that this investment is giving you 76.31 if value of the money for you is 3%. Okay. Okay. Let's see here instead the net present value of this investment. Okay. The complete graph of the net present value. So equal XNPV. Okay. Your discount rate is written here. The values, the dates. It's the same thing, but I will build it for every discount rate. So at the end we'll have a graph. According to the discount rate, you will see the net present value. Okay. Now, if I drag it down, as you can see, there is a little problem because G2 becomes G3, and that's correct, but B2, B5, and A2, A5 should not become B3, B6, A3, A6. So we dollarize them. And now we can drag it down. Okay. Let's see the net present value according to discount rate. If the discount rate is very small, as you can see, you are earning a lot of money. Okay. Then it decreases, 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 decreases. At a certain point, more or less here, between 11 and 11.5, your discount rate, your net present value becomes negative. So it crosses the x-axis, it crosses the horizontal axis. So there is a point which crosses the horizontal axis. This point is called internal rate of return. Okay, then it becomes negative. Let's see the graph. You will learn later to build the graph. For the moment, just follow me. Okay. This is the graph. You can see the net present value, the internal rate of return is around here, around 11%. It's not a line, it's a little curved. Okay. Let's see here how to find the internal rate of return. Again, I repeat, you should have read the financial functions book. Otherwise, you don't understand what I talk about: internal rate of return, net present value, values, dates. Okay. The internal rate of return wants a third parameter. It's optional. It's guess. It's a help for Excel because Excel doesn't have an official formula to calculate it. It tries to guess it. It tries to guess it using numerical tools. Usually the guess is very correct, but sometimes it takes a lot of time. So it's better that you give him a hint. In this case, we don't give him any hint. 11.2168103%. Okay. I repeat, it's an approximation because Excel doesn't have any analytical tool to calculate it, so it may be slightly wrong. Okay, so calculating internal rate of return and net present value is very easy. Building the graph of the net present value with respect to discount rate is also another thing which is very easy. Let's see some examples of a negative internal rate of return. Clearly it has no economical meaning. Let's see the cash flow. You pay 1 million euro, but you receive 1 million euro, you pay 500 later, you can see later, and you pay 400 later. Well, why the internal rate of return is negative? Because this is a nonsense investment. You receive the money now, and you pay it back later less than what you have received. Well, considering that you have already a gain from the fact that you have received the money now, paying back later less than what you have paid clearly has a negative internal rate of return. So there is no discount rate which can compensate this fact here. So let's see. XIRR. According to the version of Excel which you are using, this may give you an error or a negative internal rate of return. In this case, it gives me a negative internal rate of return. Let's see the situation where there are two internal rate of return. So the internal rate of return is not unique. So this is the situation. You receive 1,020 euros. You pay 2,000 and then you receive 1,000. So at the end you have received 20 euros more. But with the fact that you have paid 2,000 in advance, and then you have received the last 1,000 much later, okay, you will see the graph is very strange. Let's build it here. XNPV. The values. F4 to dollarize them. The dates. 13.78. Let's drag it down. You can see positive, then it becomes negative, so there is a crossing of the x-axis here. Then negative, then it starts to go up and positive again, another crossing of the x-axis. Let's build the graph. You can see clearly the two crossings are here and here. So we have, it's a case where we have two internal rates of return. From an economical point of view, it's very difficult, this case, because you don't have any measure of how good is this investment. Let's see what Excel tells us. Probably he will tell us one of them randomly, usually the lowest one. No, he will give us the num error. Okay, let's see if we say we give him a hint. I am giving him a hint, 1%. No, again the num error. So Excel, in cases like this, gives you an error. Okay. Sometimes he does not realize there are two internal rate of return and gives you just one, but if he realizes, he will give you an error. So net present value and internal rate of return are two very easy financial functions that will help you a lot building complex formulas, especially internal rate of return. Okay. Let's talk about these two things. The tasso annuale netto and the tasso annuale effettivo globale are two measures that are used, officially defined by the Italian law. The tasso annuale netto is basically the internal rate of return of a loan. So if you ask for a loan, a debt, you make a debt, there should have the person who proposes the debt to you should have written the tasso annuale netto, which is the internal rate of return of the debt. Usually the amount of money that you must give back is so complicated that it's very difficult for you to calculate it by yourself, but the law forces the one who proposes the debt to write clearly the tasso annuale netto. What is the TAEG? The TAEG is a similar thing, but which includes also all the hidden and administrative expenses. Many times there are hidden and administrative expenses which change things a lot. The tasso annuale effettivo globale includes also this thing, so it's a much better measure. Let's see it. Loan 1. Okay. You have here, the loan starts on the 1st of January 2013, you pay back on the 23rd of July 2017. You receive 20,000 euros and you pay back 20,200. Let's see the internal rate of return. Values. dates. It's very easy. This one can also be calculated using directly a formula, but we have the function. 2.11%. Okay. Let's see a more complex one. You receive 4,000 euros, pay back 1,100 every year. Okay. So let's see it. XIRR values. .92%. Okay. Well, in case you don't have hidden and administrative expenses, the TAN and the TAEG are the same thing. But in case you do have hidden and or administrative expenses, this one is the TAN. Okay. Let's see the TAEG. I have here presented as an example 100 euros of expenses at the beginning of the debt, okay, and 50 euros of expenses at the end of the debt to close everything up. So let's see how does it change. Values, dates. You can see the percentage charged upon you is 5.45%. Here it was 3.92. So the things have changed a lot. The reason of the change does not lie in this 50, but lies in this 100, because it's money that you pay immediately. This one is money that you pay after 4 years, so its value decreases. So in fact, if I put it to 0, it's 5%, so the change is not dramatic. This one is the one who charges a lot. If I put it to 0, 4.3. Okay, so the hidden expenses can change your internal rate of return a lot. Okay. Let's see another type of loan. There's a typical loan which the name in Italian is mutuo. Okay. It's a loan which usually it's a very big loan. You ask it, and then every month you pay back a little quantity of money, usually for 20, 30 years. So it's a loan with a very, very long duration. Okay. Usually people would like to have constant payments. So would like to pay the same amount every month. Okay. Sometimes a constant interest rate is offered. Okay. So there are here three things which play a role. The amount of payment, the monthly amount of payment, which can be constant or variable. The interest rate, which may be constant, so decided at the beginning, or variable, which usually follows the economical condition, usually follows the inflation rate. And then the duration of the debt, okay, which may be fixed at the beginning or variable itself. Okay. These three things work together. If one of them is variable, another one must be variable, otherwise, in order to compensate. Okay. So there are many different types of loan. Now we'll see a typical loan table. This one. Okay. I will delete it and we'll build it ourselves. Okay. Let's delete also these things here. Okay. Okay, this is a debt that you make of, let me see, 200,000 euros. Pay attention how do I build this table, because I may ask you to build similar tables at exam. You obviously can use the Excel sheets, but you must be able to understand what's inside. Okay, let's see how to build it. You have a debt of 200,000. Okay, you ask for a debt and the bank gives you 400,000. Everything which is here in these three columns happens at the 1st of January. Okay, the rest here happens at the year's end, so 31 of December. The 1st January, you don't pay anything. It's stupid. You have just received the money. If you have to pay something immediately. So your remaining debt is equal to the debt minus what you've paid. Okay. I know it's still the same, but we'll need the formula later. Okay. Finally, at the year's end, the bank will charge you interest. So don't expect that they don't charge you interest. How much interest? Well, equal to the remaining debt at the beginning of the year multiplied by the interest rate. Okay. We have supposed here that you have a fixed interest rate of 6%. So this is an example with fixed interest rate. In Italian, a tasso fisso. Okay. What happens at the beginning of the year? So the next day, you make your New Year's Day party, and then the next day your debt is the remaining debt plus the interest. So your debt has become more, so there is nothing to party. Okay. Now you pay. How much do you pay? Well, suppose that you pay 30,000 euros. So we make here the assumption that you pay yearly. Usually you pay monthly. Okay. But paying monthly will need a table which is very long. Let's build a table with yearly payment. It's much easier for us, for our example. Your remaining debt, therefore, is this one minus this one. Okay. Well, we can drag it down directly. Tac. Okay. This happens on the 1st of January. At year's end, your interest, I drag down, no, 0 is wrong. Your interest is this one by this. I put a dollar, so when I drag it down, the C1 will not become C2. Okay, 10,920. Okay. Again, here I drag down this time. This is your debt. You pay always the same. So suppose we suppose therefore constant payment. So constant payment and constant interest rate. Your remaining debt. Your interest at the year's end. Let's drag it down all together. Oops, there is a mistake here. Okay. Again, we have to drag down. Again, the mistake. Will this debt end sooner or later? Okay. We are here. In year 2025, your debt is 23,000. Obviously, with a debt of 23,000, you don't pay 30,000. You pay 23,156,31. You pay what remains. And your debt is over. Okay. However, so this is a loan table. Okay. It includes all your situation. What is your debt at the beginning? What you pay at the beginning? What is your debt at the same day, because you have just paid? And at the at the end of the year, what is the interest that your bank charges? You can see that at the beginning your bank charges really a lot of interest because your debt is a lot. Then it decreases dramatically up to here. So at the beginning, the money that you pay is used only to pay interest. Later is used to pay interest and especially to reduce the debt. Okay. However, for a mysterious reason, banks and people don't like the fact that they pay a constant amount of money and on the last year they don't pay a constant same amount of money. It's a psychological reason probably, but people and banks don't like it. They prefer that you pay the same amount of money every year. So what can we do? Well, we can try to pay a little less, 29,000, and see what happens. No, too less, 29,500. Too much, 29,400. Too much, no, too less, 450. So you can see you can go on with this approximation, okay, until you find a good number. It's around 29,440 and 61 maybe. So until you find the exact number, okay, it can be done. And this way you will have constant payment. So constant payment, a constant interest rate. However, it's silly that you have to try it yourself randomly until you get the right value. Okay? Because there is the wonderful function PMT. The function PMT gives you exactly this number. You should specify the rate. Rate, we mean interest rate. The number of periods is for how many years do you pay. So you pay 1, starting from 2017, 2, 3, 4, 5, 6, 7, 8, 9. PV. PV, it's present value, but don't worry. For us, PV, it's your debt. Forget about the other two things that are not important. We'll do just a simplified course on financial functions. And the result, you can see, 29,404,45. This is the exact payment, so 29,404,45. Let's drag it down. Okay, there are 3 cents. You will probably make a gift to your bank of 3 cents. Okay, so the PMT function tells you exactly what is the payment that you must make if you want to have a constant interest rate, 9 constant payment, and pay back a debt of 200,000. As I wrote here, pay attention, the payment is negative. Okay. So for Excel, you can see Excel has written a minus because for Excel is a payment and therefore it's negative. It's just a technical reason. Everything which has to do with this kind of function, PMT, IPMT rate, etc., for Excel, payments are negative. So you will don't worry if you find negative numbers, and in some situation you will have to enter negative numbers yourself. IPMT is used to find out the values in this column here. They are used for accounting reasons, so usually normal people are not interested in them, but a company will be interested in them because for accounting reasons the interest must be put in a special table, etc. IPMT. You should specify the rate, the period for which you want the IPMT. For example, I want it for the third period, the number of periods, 9, and the present and the depth. 9848, you can see it's here. So it means that in the third period, 1, 2, 3, okay, I will have an interest at the year's end of 94848. I repeat, it's not useful for standard people, for consumers, but it's useful for companies which must have an official accounting system and they need to know the interest, etc. You can do also the vice versa. As I told you before, rate, number of period, and your depth and the payment are 4 quantities which are completely interconnected. So you can determine the rate if you know all the rest. So if you specify how many payments, 9. What is the payment? Minus 29,404,25. And what is the depth? 200,000. Okay. So pay attention. How many payments? How much do you pay? And pay attention because it must be negative, because it's something that you pay. And your depth, it will give you your interest rate, 6%. Okay. What happens if you put it positive? If you put it positive, you will get the num error. So don't call me at exam asking me why rate doesn't work. Okay, it doesn't work because payment must be negative. And let's see what happens if the bank asks me. So the bank tells me, very well, we have a wonderful loan of 200,000, 20 payments, so 20 payments of 15,000, and 200,000 is the total value of the loan. Okay? So with the rate function, you can easily find out what is the interest rate that the bank is charging you. It's practically an internal rate of return function. We could calculate the same thing using the IRR function. Okay? We don't do it with the IRR function because if your loan has 50 periods, we need a table long 50 lines. It takes years to build it. There is a mistake here because it's the euro, so let's convert it to percentage. Okay, 4,22%. So if your bank offers you a loan with 20 years, 15,000 euros per year and 200,000 euros as a loan, it is charging you 4.22. Finally, the number of periods. How many periods does it take for you to pay back your loan? Well, if you do the calculation with, in this case, the result will be 9. Let's do the calculation in more interesting things, in more interesting situation. Suppose your bank tells you, well, we have a loan of 5%. You should pay every year 10,000 euros, and we will give you 100,000 loan. Please convert it to a number. It will take 14,21 years to pay it back. What does it mean, 21? It means that for 14 years you will pay 10,000 euros. And for the last years, the 15th, you will pay a little less, more or less. Okay? Because 10,000 is not the correct number to pay it back in an exact amount of years. Okay? So 14.21. If you want to know what is the, let's do as an exercise, please find out what is the exact amount of money to pay back a loan. So question is, what is the exact amount of money to pay back a loan in 14 years? A loan of 100,000 in 14 years. So equal PMT, obviously, rate. I didn't give you the rate. Let's suppose it's the usual 6% or 5. What was it here? 5%. So rate 5% equal PMT 5%. Number of periods 40 years. Present value 100,000. 10, 102,40. It's negative again because for Excel every payment is negative. Okay, so this is how can you pay back a loan. Okay, today we will speak about loan with variable interest rate. Last time we talked about a loan with constant payment and constant interest rate and a fixed duration. So everything was fixed and constant. Now we start to introduce variation. The interest rate now will vary, which is the typical case. Having a constant interest rate is rather rare. A variable interest rate, so an interest rate which changes every year according to the economical conditions of the market. This has an automatic implication. Either the duration changes, so you continue to pay the same amount of money, but the duration changes. Okay, in this case you have constant payment and a variable length, or the duration is fixed, but in this case what changes are your payments. So if your interest rate is variable, either the duration or the payment must vary. In this case there are no functions, so you may not use these functions here. You must absolutely build the table, the entire table. It's the only way for you to keep track of everything which is happening. Let's see how to do it. We open the usual file. Okay, we go to loan 3. Okay. Let's clear it up. It's the usual, no, we don't clear it up. It's the usual table. It's exactly like loan 2 table for the moment. The only different thing is that now the interest rate is not written here, so it's not a fixed quantity, but it's a quantity which depends on the year. So each year has its own interest rate. It's an oversimplification. Usually the interest rate changes every 3 months, or even more often. But let's take it as simplification. Since payments are made every year, let's take a yearly interest rate. So if the interest rate is 6%, as usual, with a payment of 29,404,44, the debt of 200,000 euros is repaid back within 9 years. So exactly as before. Now let's complicate the thing a little bit. Suppose that, for example, 2019, instead of having an interest rate of 6%, economic conditions get worse and the interest rate rises to 9%. Okay? So we make this modification. At this point, the bank supposes that automatically also all the future interest rate will be 9%. Okay? It's not true. The bank in 2019 doesn't know what they will be, but make prediction on the future basing on the fact that the interest rate could be the same of 9%. So you can see what happens. If the interest rate remains of 9%, what happens is that paying back 29,404 will not finish your debt by 2025, as you can see here. By 2025 you will still owe to the bank 21,274 euros. So what happens? Well, it happens that we have to add another payment, 2006. Okay, so we drag down. Well, you pay exactly what is missing, 23189,09, and your debt is over. So this is the case, for example, of a constant payment. So your payment is kept constant, obviously for all the time except the last year, and a variable length. With a variable interest rate, it's impossible to keep your payment constant all over the year. The last year will be different. So you have kept your payment constant, but due to the variation of the interest rate, you had to add another payment, so your duration has a length. Suppose that here, again, the economic condition get even worse, 15% a high inflation. So the bank supposes that 50% will be the rest, the interest for all the other years. And let's see what happens. Okay, you have to add, unfortunately, another year, so 2027. And I think also another one, 2028. Okay, you pay always the same amount of money. Okay, here you pay 27,213,67, and your debt is over. Okay, so 2028 is not necessary. So you can see that a variable interest rate may have the implication that if the interest rate rises, you have to add other years. On the other hand, if the interest rate lowers, so here for example 3%, here it becomes 2%, even less, you will probably finish your debt earlier. In fact, here you can finish your debt by 2025, paying only 9,451,93. No, there's a mistake. 9,640,97. Okay, and these are not necessary anymore. Okay, so this is the variable interest rate, fixed payment, obviously a variable duration. There is no problem in the calculation. You simply go on paying the same amount of money, and you just lengthen your debt of what is necessary to pay it back. The only problem which may arise here is a very, very high inflation. For example, 25% of interest rate. In cases like this, 25% of interest rate, you can see the interest that you have to pay every year is much more than what you pay. So it means that your debt, as you can see, doesn't decrease, but will start to go up. In cases like this, so when the variable interest rate is so high that your debt will go up, and means that you will never end because your debt will continue to increase, your bank probably will call you and ask you to pay more. So even though you have a constant payment, in cases like this, you will be forced to pay more, because otherwise your debt will increase indefinitely. Okay, let's see now, let's go back to the original 6% and see now the situation, okay, in which you don't have to do constant payments, so you have a variable payments, but you want to keep your duration fixed, so you want to end by 2025. This situation has a little technical difficulties that we will see. Suppose that in 2019, instead of 6%, it's 9%. The bank makes the usual assumption that 9% will be all the other years. Okay. Now what happens? Well, you have already paid in 2019 your 2944,45, and that's okay. So this has been already paid and nothing can be done about it. But the bank will change this value here, so we'll change the value here. Okay. How much will it be? The value decided by the bank here will be that quantity for which the bank can finish off your debt by 2025. So the bank at this point has to redo the calculation and find an appropriate value in order to finish the debt by 2025. How can we do it? Well, we can do it again as before by trial and error, for example. So just supposing you pay a little more, not too much, 33,000, too much, 32,000, okay, too little, 32,500. Okay, so you can try by trial and error, but now you have understood that you can also use the PMT function. Exactly in the same way we have used it here to calculate this 29,404, we can use the PMT function here to calculate what you should pay here. Pay attention, however, because now the debt is already going on. Okay, so it's not a debt which is started now, it's a debt which is already going on. So we must carefully decide which are the arguments of the PMT function. Equal PMT. Okay, let's put it here, equal PMT. First, the rate. The interest rate is clearly 9% now. Okay. How many periods? How many periods do we pay? 1, 2, 3, 4, 5, 6. So it's not 9, it's 6 because you have left 6 periods. And what is the value of your debt? For sure, the value of your debt is not 200,000 because you have already paid a part of it. So how much is the value of your debt? Well, I know that you may be tempted to say 157, or you may be tempted to say 173, but they are wrong. Let's see. Suppose you'd say, okay, it's 157, okay, because you see the debt here. So you should pay 35,133,14. It's however wrong. You can see you're paying too much. Why? Because this number here is not the right value of your debt. Can you see here? Here the right value of your debt was 200,000. It was not 212. So it was not the debt on the first year of the payment, but was the debt on the year before. So this one is wrong. It's not the right number. It's wrong because this one has already inserted the interest of the previous year. Okay, so you may also be tempted to say, okay, the debt is this one. So I take the debt of the previous year, exactly as I've done here. In order to calculate this 29,000, we have taken 200,000, so the debt of the previous year. But unfortunately, also this one is wrong. 38,000, well, if you try to put it here, 38,787,07, it will clearly see that it's wrong. It's wrong because this number here does not include what you have paid on the previous year. Okay. This quantity here. At the beginning, in the first year, you pay nothing. Okay. So this is the right number to take. In this case, this one. So pay attention because this one, the one I have put orange, is the right number to take in order to recalculate your payment. So this one is the correct one. So the right number to take is this one, the remaining debt on the year before. Okay, but not the debt, the remaining debt. So right after you have paid. So pay attention, you may be tempted to take this one. You may be tempted to take this one, but the right value to recalculate your debt is this one. Because this one includes what you have paid the year before, so 29,000, and does not include the interest rate. So it's the correct number. 32,232,24. So 32,232,24. 0. Okay. So pay attention when recalculating your debt. In order to recalculate it, take the new interest rate, take the remaining number of years, and as debt, take this one. So the remaining debt of the year before. Okay, this is how the loan table is built. This is the other situation, what I will build now. It's a situation when the number of payment is the same, so your debt will be paid back in a fixed amount of time. And but your payment is not constant. So whenever your interest rate changes, automatically your payment changes. Obviously, in a real bank, all these calculations are done automatically with a computer. Okay, so there's not a person who manually changes the table every time. Okay, so we have seen the situation of the loan with variable interest rate. In this case, there is no alternative. You must build a table. You can still use PMT for this case here, okay, to recalculate the payments. Okay, but you cannot use the three function PMT, rate, and NPER to build the entire table.